Ladies and gentlemen, welcome to Boss Economics World. In today's segment, we're going to dive deep into the chaotic and twisted web the global economy finds itself entangled in during the early months of 2025. What we have here is a veritable feast of contradictions, policy missteps, and economic blunders. Stick around because by the end of this video, you'll either be laughing at the comedy of errors or shaking your head in disbelief at how governments, especially the US, are still getting away with firing on all cylinders while the rest of the world fumbles and stumbles over their own feet. Let me start with a bold statement that might rile up some folks out there. The US economy is like a well-oiled machine on steroids in 2025, cruising at a comfortable speed, leaving the competition eating its dust, and yet, still not in the clear. Yes, ladies and gentlemen, there's trouble on the horizon, but for now, others are crashing before the US hits any bumps in the road. The US GDP growth streak is an enviable accomplishment, with Bloomberg's economists forecasting a near 2.7% annualized GDP growth for the fourth quarter of 2024. But before you grab your pom-poms and start cheering on Uncle Sam, there are cracks in the foundation that we'll get into. Let's peel back the layers of this economic onion, shall we? Because while the US sips its champagne to celebrate a third quarter of resilient consumer spending, roaring above 3%, powerhouse economies over in Europe are facing stagnation, contraction, or downright humiliation. Now, let's switch gears and take a look at Europe. Can we have a moment of silence for the French and German economies? That's right, the so-called pillars of the European Union look about as lively as weekend traffic in a snowstorm. While American consumers are busy making Bezos richer with their spending sprees, across the pond in Germany, it's a different story. The GDP data from Germany is expected to reveal slight contraction, and similar stagnation is expected in France. But Europe's slow-moving economy is no new headline. Germany and France are pulling the Eurozone down with their inability to break free of years of sluggish economic management. Bloomberg also earns another gold star here for citing a paltry EU-wide GDP growth of just 0.1% for the quarter. These growth rates aren't just bad, they're abysmal, especially for nations that like to think they can hold their own alongside the US. But what's causing this stagnation in Europe? Let's dig a little deeper. The answer is probably somewhere between policy timidity and inflation indecision. ECB President Christine Lagarde's 25 basis point cut might as well be a shot in the dark at this rate. Leading think tank commentators have pointed out that the combination of sluggish reforms, tariff uncertainty surrounding US trade relations, overcautious monetary policy, and staggering energy crises have buried European households under financial strain. Consumers aren't about to spend when they're being squeezed from all sides, interest payments are still pinching their wallets, while fuel bills rise steadily. Don't be surprised when Europe continues to lumber along at a pace not faster than a dying turtle in 2025. Did I mention inflation as a stubborn guest at the global financial party? In 2025, it's like that unwelcome family member who shows up to every gathering, eats everything, and leaves the mess behind. The Fed's December 2024 projection of just 2 rate cuts for the year set pulses racing, with many accusing Washington of keeping rates too high, too long, in their attempt to control inflation. But look, let's be real, the US labor market is still strong, and inflation is clearly not under control. By holding borrowing costs steady, the Fed may just avoid tipping the boat over. But for how long? Bloomberg data offers worrying trends. The Fed's preferred inflation gauge, personal consumption expenditures, PCE, excluding food and energy, inched upward. We're still looking at upward movement in prices in many areas despite months, if not years, of monetary tightening. And you know who's feeling it most? American households. Inflation disproportionately punishes those at the bottom, those who can't absorb the higher costs of essentials like food, gas, and rent. In the meantime, Credit Suisse reports predict more Americans will be maxing out their credit cards to fund daily expenses, a sharp rise compared to last year where consumer debt flirted with dangerous levels. Or worse still, because, get this, year-on-year inflation is expected to have lingered around 4%, besting Eurozone inflation stuck in the 2% to 3% territory. While that might look better on paper, the dilemma for everyday folk is obvious whether you're a middle-income New Yorker or a London commuter. Prices aren't coming down in essentials. Remember the days central banks said inflation was transitory? Guess that was a good joke. Added to the greatest hits of 2023 to 2024 policy errors. Let's take a quick ride up north to Canada, where Prime Minister Justin Trudeau and his Bank of Canada, BOC, governor seem to be in an awkward dance of their own. GDP data will likely reflect Trudeau's short-term celebration with a December tax holiday that boosted consumer spending for a brief moment, but let's not fool anyone here. Unlike the American neighbor, Canada's economy remains fragile, growth is minimal, and to truly top off this cake, Trudeau also must deal with the tariff tantrums from President Trump. Make no mistake, the BOC's expected 25 basis point rate cut on Wednesday isn't a heroic move either, it's essentially a controlled retreat after their earlier aggressive rate-cutting action of 2 consecutive 50 basis point chops. Whether or not this will invigorate Canada's sagging growth remains to be seen. The problem for Canada is its over-reliance on American strength, just ask any economist concerned about their export markets. Don't think we're done yet, folks. We have a relatively quiet situational update over in Asia, excluding of course Japan, whom we'll have words about later. But taking stock of China, South Korea, and Hong Kong, it's evident they're taking a back seat for a moment while economic festivities pause for the celebratory Lunar New Year. However, if we peek under the surface, the dragon isn't breathing fire economically because the Chinese economy continues posting concerning red flags. Manufacturing data for January paints a bleak picture of yet another month of profit declines within industrial sectors. Sound familiar? That theme echoes across the globe. You can already sense something cooking beneath the surface. How long before Beijing might take brave, sweeping measures? Let's hope Xi Jinping's next policy update does something bold. Now, about Japan. Japan's central bankers have definitely stirred the pot, with a sudden rate hike to levels unseen in 17 years. The news sent shivers across financial markets wondering what comes next, because while raising rates in Japan sounds unusual, this may just be foreshadowing major changes down the line. Japanese unemployment has kept steady, and Tokyo's consumer prices have inched slightly upwards, but in reality, economic momentum seems lacking post the heightened monetary policy tightening. Lastly, down in Latin America, we see a fascinating contrast between Brazil and Chile. Brazil's Banco Central is opting to boost interest rates by yet another 100 basis points to a whopping 13.25%. That's right, there's an unhinged inflationary beast roaming in Latin America. Brazilian inflation regulatory forecasts are currently 5% year-on-year and worsening. Meanwhile, peso weakness pressures imports and squeezes consumers tighter. On another note, over in Chile, despite losing momentum, the central bank's shift seems frozen between letting inflation run or stepping deeper into unpopular directions. As we conclude today's hot take, one thing stands out across boss economics world: local economic blunders, half-baked policies, and timid reform means difficult months ahead, even if powerful metrics like U.S. outperformance try eclipsing problems underfoot. From the runaway U.S. consumer spending uptick to tragic Eurozone slowdowns and Asian uncertainties paired with Latin volatility, global interdependencies shaping this year don't promise a neat stabilizing economic horizon anytime fast. The governments calling the shots appear incapable of learning from yesterday's tragicomic mistakes. The Fed walks a fine line between holding on too tight, while Europe drifts further toward economic irrelevance, dragged down by its sagging core economies. Economists worldwide sit with bated breath praying for income growth smashes inflation ceilings internationally one day too.